In today's volatile economic climate, inflation is a significant concern. According to economic expert Jim Rickards, hyperinflation is not just a distant threat, but an impending reality. Rickards argues that the Federal Reserve's strategy of raising interest rates will backfire, exacerbating inflation rather than controlling it. As we brace for this economic storm, it is crucial to understand the implications and the opportunities that lie ahead. Rickards believes that the Fed's current approach will push the economy into recession, with unemployment potentially rising to 4% or even 5%. This grim forecast comes despite Fed Chair Jerome Powell's insistence that enduring some pain now is necessary to avoid worse outcomes later. But what if the very measures meant to stabilize the economy are in fact setting the stage for greater turmoil? The Federal Reserve's long-standing policy of inflation targeting aims to maintain a minimum of 2% inflation per year. The idea is that consistent, moderate inflation ensures price stability and smooth economic functioning. However, Rickards challenges this theory, pointing out that despite aggressive interest rate hikes, inflation has continued to climb. The historical context is alarming. Between 1913 and 2023, the dollar lost 95% of its value. More strikingly, during the 1980s, the dollar lost half its value in just 5 years. Could we be on the brink of a similar economic upheaval now? While Rickards' predictions paint a dire picture, savvy investors know that market volatility often presents unique opportunities. As inflation erodes purchasing power and interest rate hikes squeeze consumer spending, certain sectors may prove resilient or even thrive in times of hyperinflation. Commodities and real assets like gold and real estate often become safe havens. These assets tend to retain value as currency depreciates, offering a buffer against inflationary pressures. Investors should consider reallocating portfolios to include these tangible assets, providing stability amidst economic uncertainty. Despite macroeconomic challenges, sectors driven by innovation, such as technology, can continue to show robust growth potential. Companies at the forefront of technological advancements, particularly those developing solutions for efficiency and automation, could outperform the broader market. Investing in these forward-thinking companies might provide significant returns even as traditional sectors struggle. While the prospect of hyperinflation and recession looms large, it is essential to approach this period with a strategic mindset. Understanding the limitations of current monetary policy and identifying resilient investment opportunities can help navigate the turbulent waters ahead. By focusing on tangible assets and innovative sectors, investors can position themselves to not only weather the storm, but potentially emerge stronger. In a series of 6 speeches, Jerome Powell, the chair of the Federal Reserve, has consistently emphasized the need to achieve 2% inflation. This goal, according to Powell, necessitates further interest rate hikes, which will inevitably lead to a recession and higher unemployment. Despite Powell's hawkish stance, the market has shown unexpected resilience, rallying instead of declining. Powell's repeated warnings would logically suggest a bearish market response. Higher interest rates typically mean tighter financial conditions, reduced consumer spending, and slower economic growth. Yet, contrary to these expectations, the market has rallied. Investors seem to believe that inflation will soon be under control, which has buoyed market sentiment and driven prices higher. Economic analyst Jim Rickards offers a different take. He suggests that the Federal Reserve has already reached what is known as the terminal rate, the point at which inflation will start to decline naturally without further rate hikes. In Rickards' view, the current interest rate level is sufficient to curb inflation over time. However, he criticizes the Fed for continuing to raise rates, which he believes is exacerbating economic woes and pushing the economy closer to a crash. Rickards' argument highlights a critical risk. By overshooting with interest rate hikes, the Fed may be setting the stage for deeper economic troubles. Each additional rate increase tightens financial conditions further, potentially stifling growth and increasing unemployment more than necessary. If inflation is already poised to decrease on its own, continued rate hikes could prove counterproductive, harming the very economy the Fed aims to protect. So the key question remains, when will the Federal Reserve recognize that it has reached the terminal rate and cease its aggressive rate hikes? According to Rickards, the Fed needs to acknowledge the natural lag between monetary policy implementation and its impact on inflation. If the Fed continues on its current path, the risk of a severe economic downturn increases. When the government spends money, they are injecting it into the economy. The money that the Fed created is given to the banks, which then give it back and destroy the money. However, deficit spending by Congress goes into the economy, buying weapons, funding welfare, and other programs. This spending creates growth, but at a high cost. In the fourth quarter of 2023, the U.S. economy grew about 2.4% to 2.5%. However, the national debt grew faster, at about 3% to 3.5% on an annualized basis. This results in a rising debt-to-GDP ratio, indicating that while there is some growth, the debt is increasing at a faster rate. With interest rates soaring and government spending running rampant, many are wondering how to safeguard their money from the corrosive effects of inflation. The Federal Reserve insists on further rate hikes to curb inflation, while the market seems to believe that inflation will soon subside. So who's right and who's wrong? Let's delve into what Jim Rickards thinks and explore strategies to protect your investments. The current economic landscape is characterized by high interest rates and significant government spending, a combination that creates uncertainty and volatility. The Federal Reserve's commitment to raising rates aims to tame inflation, but risks pushing the economy into recession. On the other hand, rampant government spending can fuel inflation, undermining the Fed's efforts. Jim Rickards believes that the Fed has already reached the terminal rate, where further rate hikes are unnecessary because inflation will start to decrease on its own. He argues that continuing to raise rates would cause more harm than good, potentially crashing the economy. According to Rickards, recognizing when to stop is crucial to avoid deepening economic distress. In such a tumultuous environment, safeguarding your money requires strategic planning. Here are some investment strategies to consider based on Jim Rickards' insights and broader market trends. 1. Diversify with tangible assets. Precious metals like gold and silver have historically been safe havens during inflationary periods. They tend to retain value and can provide a hedge against currency devaluation. Investing in real estate can also offer protection against inflation, as property values and rental income often rise with inflation, preserving purchasing power. 2. Invest in inflation-resilient stocks. Companies at the forefront of innovation, especially in technology, can continue to grow despite economic challenges. Look for firms with strong fundamentals and a track record of resilience. Stocks in essential goods and services such as food and healthcare tend to perform well during economic downturns, as demand for these products remains steady. 3. Consider high-quality bonds. Treasury inflation-protected securities, TIPS, are government bonds specifically designed to protect against inflation. The principal value of TIPS rises with inflation, providing a reliable safeguard. Corporate bonds from high-quality companies can offer stable returns, though it's important to be selective and focus on companies with strong credit ratings. 4. Monitor monetary policy and market trends.
Stay informed about the Federal Reserve's actions and broader market sentiments. Understanding the dynamics of monetary policy and its impact on various asset classes can help you make more informed investment decisions.
Ultimately, who's right? The Fed or the market? The debate between the Fed's stance and market expectations continues. While the Fed insists on further rate hikes, the market's optimism suggests a belief that inflation will soon be under control. Jim Rickards' perspective adds nuance to this debate, emphasizing the importance of recognizing the terminal rate and avoiding excessive tightening. By focusing on tangible assets and innovative sectors, investors can navigate these turbulent waters and potentially emerge stronger. Thank you for watching, and please do not forget to subscribe.